I'm going to test my audio. I'm going to see if test. Test my audio. All right, perfect. I can hear it on my end. All right, I'm going to keep carrying on with this Google research that I got going on. But the idea for this is to do some financial ratio comparison. So we got a basket of stocks. We got Google, we got Netflix, we got some Mag Sevens, got Oracle and Datadog, since they do cloud and data solutions. We got Snow as well. Um, and the takeaway here is that if you look at Google's price from a price to free cash flow perspective, price to share or sales, price to earnings, EBITDA, and that's trailing, you could see that Google trades at a discount from all four ratio perspectives. So obviously, Google's trading at a discount because of the legal and LLM like ChatGPT risks to search. So now we have to make the decision of whether or not incurring this risk is worth today's discount and the value of the stock might appreciate in the future. And I would also like to get into Walmart stock because they have earnings coming up on that too. So that would be an interesting play as well. With my current thought process with Google, we're gonna keep it. We're gonna stay with Google for first. But for example, YouTube TV watch time in the U.S. is greater than Netflix TV watch time. So YouTube, in and of itself, is dominating television watch hours in the U.S. So that in and of itself is worth something, right? So if I tried to figure out what Google's market cap is, conveniently, Netflix's streaming revenue is 10 billion in the most recent quarter. So if YouTube has more if YouTube has more watch time on televisions than Netflix does, and YouTube, aka Google, has a bigger market share, and they conveniently both make 10 billion in revenue because Netflix streaming makes 10 billion per quarter, and then compared to Google's YouTube, Google makes 9 billion per quarter. So let's say we make the assumption that Google's YouTube market cap should be worth the same as Netflix, just to get some comparison, just to get some baseline to attempt to value how much Google should be valued based on other competitors. So then that brings us to, okay, what about cloud? Because cloud is another large piece of Google's revenue. It's has increased 203% since March of 2021, and then here we are today. Google Cloud is up to 12 billion per quarter. So it used to be just 4 billion per quarter Now Google Cloud's raking in 12 billion in a quarter, up 200%. So it's a fast growing business. Sure, it's not yet close to 50 billion, but if Google can pivot, maybe cloud would be a bigger portion of their business than it currently is. But anyway, if we go back to comparison analysis, let's look at Oracle, because I didn't want to look at Amazon's AWS because it'd be hard to parse out how much AWS should be worth, since Amazon also has the distribution shipping business. They have the streaming business and all that. So Oracle was a better apples to apples comparison, since I want to compare Google Cloud to Oracle Cloud. So Oracle Cloud Services revenue was 11 billion, and this is the stake for Oracle, because they had other there you go. I don't know why I wasn't able to click on it. Because Oracle had other forms of income like cloud licenses. That was 1 billion, because this is in millions. Hardware was 700 million. Services was another billion. So to keep the analysis simple, I'm gonna ignore 3 billion from Oracle, and I want to compare Google Cloud. So I'm using this 11 billion number from quarter three. But we take that number and we're saying, okay, Oracle Cloud services revenue is 11 billion compared to Google Cloud in the most recent quarter is 12 billion. So we can say, okay, for simplicity and assumption, I'm going to say Google Cloud might be worth the same as Oracle. So we're gonna say Oracle's market cap is 421 billion. So let's assign the percent of Google's market share in cloud, makes it 22%. So that's already 43% of the business. So that's already half of the business gone that we covered. That leaves us with Google's market share in other, and other is I clumped networks, hardware, so like the Google Pixel phone, and then other bets like Waymo's car, since that's definitely a growing section of the business. But like other bets, you could see it's only, I say only, but 450 million compared to 50 billion, right? So even though, yes, 127%, that's big, but not a core section of the business. So I'm going to clump it into Google Other. So, 20% here, 20% there. Let's make the assumption that the other section of Google should be worth 20% of the market cap. So that is another 378 billion. So that leaves us with Google Search's market cap, because that's the final major section of the business. If we assume that YouTube plus cloud plus other is worth 63% of Google's market share, that'll leave us with 37% of Google's market cap to allocate towards search. And search makes like 58 billion in a quarter, 50 billion in revenue in the most recent quarter 2025. And should it only be worth 37% of the company, or should it only be worth $694 billion? Because Google search if we took Netflix's market cap and then divided it into the supposed Google search market cap, it's only 1.7x. So Google Google search in this model, in these high assumptions, Google search is worth twice as much as Netflix, even though Google search makes 5 times the amount in revenue. And then same thing here. Google search, since we used Oracle for the cloud, let's see 694 divided by 421. That's 1.6. So Google search is worth about 1.5 more than Oracle, even though Google search makes 50 billion and Oracle's cloud services made 11 billion. So about 5 times more. So if the revenue is coming in 5 times more, should these ratios be more? Should this 694 be worth more? Is my question. So I don't know. Let's say we lower the value of the Google Market Other, right? Because that could increase the value of Google's share market cap to almost 883 million or billion, and then that'll make it so that Google search is worth twice as Netflix. Google search is worth twice as Oracle. But again, Google search makes 50 billion compared to Netflix, and Oracle makes 10 and 11 billion. So 5 times, right? Should Google search be worth more, even with the legal and LLM model threat? Because the threat provides us the discount. The threat provides us with a discount price on Google. It's just a matter of figuring out, is the discount respectable? Is the discount correct? Should Google be trading at a discount? Which I can agree with. I can agree with Google being traded at a discount because there's the uncertainty. But what's nice about uncertainty is that breeds opportunity, and this is why we need to look at Google stock and see if it's worth a position or not. And this is what we were mentioning here, right? Netflix streaming revenues 10 billion. Google search alone, that segment alone is worth 50 billion. So Google search alone makes almost 5 times more in revenue than Netflix. Google Cloud, or excuse me, I need to change that. Google search. So Google search makes 4.6 times more in revenue than Oracle. So with this valuation, if we allocate 47% of Google's market cap to the Google search business, Google search is only worth twice as much as Netflix and Oracle, but in terms of sales, in terms of revenue, they're bringing in 5 times as much. So there's our discount. Even though, like Apple mentioned in the testimony, like Google's search volumes are declining in their Safari app, at least in the financials, we're continuously seeing Google's search revenue continue to grow. So besides the seasonality that occurs typically in quarter four, we see a drop in the revenue. But overall, It's a 59% increase since 2021. And ChatGPT hit the scenes around here, like summer 2022. But we're continuously seeing the revenue increase from that line of business, 59%. So pretty good there. And of course, this is why the sell off is happening, right? We're seeing the revenue sources from quarter one, 2023, it was 58% from Google search. And fast forward to today, it's still about 56% revenue source for quarter one, 2025. So we're definitely seeing a huge portion, half of Google's revenue source is from Google search. So if you're having LLMs taking away that market share, the dominance of Google search is no longer the default option. It might make sense that Google stock sells off and there's a discount on the trade because there's heightened risk. And stock market does not like risk or does not like uncertainty. This is another ratio. So we were looking at price to free cash flow of other companies in that comparison analysis, um, or excuse me, the ratio comparison section. But we can also look at the historical price to free cash flow of we can look at the historical price to free cash flow of the company itself, um, to see if the price is relatively cheap to itself. So, for example, we're seeing the price to free cash flow of Google during 2022 and 2023 was below the stock's average of 108 price to free cash flow. And then we're seeing this situation happen today again, where quarter four and quarter one, we're seeing price to free cash flow below that average of 108. So let's take a look. Let's see, if we went back in time, let's see if buying Google stock in 2022 and even here, for example, quarter one, 2024, let's see if that would have been worth the investment. So I could bring in TradingView and let's look up Google. And I've already circled it, but we could look all the way back to 2022, right? Here's 2022. And let's say you bought right here, right? It's actually since I'm looking at it, it's actually a bearish flag pattern, right? So if you were a technical trader, maybe you wouldn't have traded right there, but for the sake of conversation, let's say 2022, you look at this ratio and you're like, man, price to free cash flow of Google's really low, relative to itself, right? So you might come in there and be like, all right, I want to buy some shares. So uh, if you bought right there, you'd be up 34%. So that's pretty good. Let's look at quarter one of, trying to see what that is. Quarter one of 2024. Let's take a look at that one. So quarter four, 2024, March, right here. Boom. That was even that's around like the dip. Yeah. You'd be up about 5%. So it's kind of flatlined, right? But, if you rode this to the peak, you would have been up 40% right there. Rode up to the peak, you'd be up 82%. You would have almost doubled your money from these entry points based on the price to free cash flow multiple. And then let's see what would have happened if you would have bought into Google when the price to free cash flow was higher relative to the average, right? So, um, back in quarter four, 2023, we saw price to free cash flow peak. So yeah, you would have been like right around here. So, let's say earnings comes out, so let's say you bought like right here. That would have been so far that wouldn't have been a good trade, right? Because now you're down 16% on that position. And then so yeah, 6 and 1. I was looking at the wrong quarter. This one was back in 2023, so December of 2023, which is about like here. So let's say you bought like somewhere around there. And that would have been like a flat trade, right? That's like 5%. Um, and then let's look at summer 2024. So summer 2024 is like around here. Let's say you bought right here and stock's down about 14%. So, these relative valuations, right? They don't always work, but because you could argue, you could erode that up. You could argue that you could erode that up, but um, I think we could also argue that those previous entry points, like here and here, would have been a lot more desirable entry points, right? So it's an example of using the price to free cash flow, and we can use that to evaluate the stock to itself based on historic values. Same thing with price to sales, right? We take market share, we take the market share divided by the revenue of the company. And we see that this was a very low point, price to sales ratio at about 15. So let's look at December of 2022, right? If we want to potentially buy the stock at a discount when the average is at 22 and the stock's trading at a price over shares of or sales of 15, right? So um, that was 2022 quarter four. So let's check that out. So we're gonna have to go back in time. What did I say? 2021 December. I already forgot. Jesus. 2022. Yeah, yeah, yeah. Quarter four, 2022. Quarter four, 2022. So here we go. Quarter four, 2022. Quarter four. So let's say you bought like right here. And funny enough, man, that kind of looks like another bearish flag pattern. I don't know. Anyway, so let's say you bought there, right? So 2022 was a pretty rough year. So we see the stock ultimately go down 33%, right? Even when that discount ratio, you can make the assumption of that discount ratio saying, hey, the stock's actually cheap, discount because the ratio is lower than the average. But sometimes that's is not always the case, right? Sometimes it doesn't materialize immediately, and there might be macro external factors or negative market sentiment. If you held it all the way through, you'd be up 16%. If you compared it to the peak, you'd be at 53%. So, still a good entry point for long term investors. And, you might have dollar cost average your way through this valley that you see in the price to sales multiple or ratio. Um, we could look at December quarter 4, 2023, for example. So we go to December all the way up here. Let's say you buy there, and the stock already kind of recovered, right? It recovered 52% since then. If you were to buy there, it's a similar position. You would have been up 15%. And then if you went all the way up, you would have been up around 51%. So similar returns on these. So you could also do these historic relative valuations. So like you could do price to earnings, EBITDA is also a very popular one to try and assess whether or not, hey, relative to history, is this stock trading at a discount and what's the reason why? Or maybe if it's way over the average, then the question is, okay, why is it trading at a premium? Is the guidance positive? Is there no headwinds? Is it all tailwinds? Um, so I mean, personally, it's like I think I would want a position in Google because historically, when the price to free cash flow was trading below the Google average, it had positive returns, similar to price to sales. If when it was trading at a negative or trading at a discount, there were positive returns around 15%. Same thing with the comparison analysis. We're looking at Netflix and Oracle, making the assumption that Google's um, market cap is equal to Netflix's market cap for their YouTube division. Same thing with Oracle. Let's make the assumption that Google Cloud is worth the same as Oracle. That's half of the half of Google's market share. We're left with 57% of the market share, and that goes to Google Other, which is the network hardwares and other bets, and then Google Search. And should Google Search only be worth twice as much as Netflix when Google Search makes 5 times more in sales in revenue? Is that too much of a discount? I don't know. And then across the board, Google trades at a discount on all of these ratios. There's a big discount. Google's on clearance. It's just a matter of just because it's cheap, does that mean you should buy it? I don't know. And trendy is not financial advice. All right. Anyway, so that was my spiel for Google. What's Google's colors? Red. Okay. So let's do Walmart blue. So let's look at some let's look at some Walmart data. Name off some Walmart competitors. Who are Walmart competitors? You got Target, you got Kroger, Costco, even. I guess we could say Alibaba, right? Best Buy, Amazon, that's a good one. You got eBay. So Walmart's price to free cash flow 61.71, sales 1.16, and these numbers are from Trading Views stock screener here. Let's look at Target. Target's price to free cash flow, we're at 9.87. So, man, uh, Jesus. What is, from a price to free cash flow perspective, Walmart's trading six times more. Price to sales, 0.42, not even one. 10.88, 6 point. I'm curious how not like outdated, but like how old is like the costs or the trading view screener data. So you got 6.64 for Costco, got 1.7, 5885, 36. Let's look up Alibaba. That's the ticker. I couldn't remember it. 21.08, 2.21, 18.11, 12.6. We got Best Buy at 10.65, 0.36, 16.10, 6.37. Amazon at 100, 13. eBay's at 15, 3.24, 16, 61, 11.84. What are the competitors we got? I guess we could say Dollar Tree, right? That could be a good one. I'll add Home Depot and Lowe's to that. Why not? We got Walgreens, we got Macy's, we got Ross stores. See, I don't think they're that comparable. So I don't know if I want to add those. We got I don't even think IKEA's public, so I'm not going to add that. See, CVS Health, yeah. Well, I mean, yeah, I guess Walmart does have a pharmacy, but I also feel like they're not that comparable. And then we got Kohl's. I think this is a good basket. I like this basket of stocks. DLTR. It looks like a Dollar Tree. And Dollar Tree stock, man, I got absolutely wrecked. DLT. 11.76 or 0.67. Price to earnings is dashed out. I wonder why. Lows. Where are you at? Got 16.26, got 1.51, got 18.20, got 13.21. All right, finally, Home Depot. We're looking at 22.08, 2.27, 24.32, 16.69. All right, let's look at which are more expensive. So interestingly, price to sales for Walmart is looking pretty good. So Walmart, from a free cash flow perspective, is trading pretty expensive, in line with Costco at 64. Walmart's at 61 price to free cash flow. Amazon really trading at a premium here, 100 on the price to free cash flow perspective. Um, Walmart, from the revenue perspective, trading 1.16. Baba and Costco 1.7, 2.2. Amazon and eBay. I'm kind of surprised at eBay. Three times. Amazon is also three. Okay. And then Walmart, price to earnings, 40, relative, that's pretty relatively high for this basket, 58. And then Amazon also at 31. EBIT to EBITDA is at 19 for Amazon, which is about medium because Costco is really increasing that average at 36. So there is some premium attached to Walmart, especially from a price to free cash flow perspective, similar to Costco. So we could take that and yep, that one's already taken. So Walmart revenue. Let's look at Walmart revenue. Full year. Yeah, I'll probably take the full year. Revenue of 681 billion. Global advertising business. Global e-commerce sales grew 16%. Store fulfilled pickup and delivery in the US markets. Global advertising business. Okay, so Walmart is replicating Amazon, where the marketplace is an engine for our business to bring in more sellers and driving e-commerce for the retailer outside the US. The growth, um, this is why I should buy puts on Google because I'm going to ask ChatGPT what is Walmart's global advertising business. So I think it's similar to, I'm assuming it's similar to Amazon, where it's like sellers can pay for ad space on Amazon's like search engine. So when you search for a couch or something on Amazon, then it's like, oh, we're going to show you this sponsored link because someone paid us to put it there, right? So Amazon's global advertising business, primarily driven by its retail media network, Walmart Connect, has emerged as a significant growth engine for the company in fiscal year 2024. Amazon's growth advertising global advertising revenue reached 4.4 billion, making a 27% year-over-year increase. This global growth underscores the company's strategic focus on monetizing its vast customer base and omni-channel presence. Walmart Connect serves as a linchpin of Walmart's advertising endeavors, offering brands the opportunity to engage with approximately 150 million weekly U.S. customers across Walmart's digital platforms and physical stores. Utilizing Walmart's proprietary first party data, advertisers can deliver targeted campaigns through various channels, including sponsored search, promoting products within Walmart's search results, so kind of like Amazon, display advertising featuring ads on Walmart's website and app, connected TV, CTV ads reaching audiences through streaming television platforms, right? Because Amazon bought Vizio, right? They acquired that. So they're running ads on those TVs. And then in store experiences, engaging shoppers directly within Walmart's physical locations. And yeah, the acquisition 2.3 billion purchase of smart TV manufacturer Vizio grants access to Vizio's SmartCast operating system, enabling the retailer to display ads on streaming devices and expand its reach into customers' living rooms. Vizio has 18 million active accounts and over 500 direct advertisers with ad revenue. So you could argue that, maybe that's why Google's trading at a premium based on those ratios, right? Okay. So advertising has become a substantial contributor to Walmart's profitability. Advertising accounted for nearly a third. Advertising accounted for nearly a third of Walmart's 6.7 billion operating income. So what would be interesting to say here is that if there's an increased probability of recession, one of the one of the markets to decline is advertising spend, right? If if companies are if companies are worried about a recession, they're going to cut back on costs, and one of those costs are advertising. Uh, so we can look at JP. Probability of recession remains at 60% as of April 15th. Recession probability. And according to the betting market, US recession probability for 2025 is at 52%. The highest it was back in April 6th at 66% chance. Now it's dropped down to 22% chance. Um, Back in 2025 February. So it used to be 22%, peaked to 64%, and now it's at 52%. Okay. So I could see that going into earnings. Perhaps we've seen many in the past 2 weeks. We saw the earnings results, and we saw companies revise their earnings or their guidance, saying, "Hey, there's a lot of uncertainty surrounding the tariffs, and talks of the recession, right, being a topic of discussion has increased since then." So we could see that guidance falter since Walmart's advertising endeavors make up about a third of Walmart's profitability. So again, if companies are not spending as much on advertising because they're cutting back costs, then that's going to also impact Walmart's performance. So this release was quarter 4. Okay, interesting. Their quarters are a little goofy because the fiscal year ended January 31st, 2024. It's interesting, right? Is that weird, or am I just being dumb? Anyway, quarter ended October 31st, 2020. Okay, anyway. Um, so they got consistent revenue growth. Quarter fiscal year 2025, quarter 4. So quarter 4, full full year 2024, 173 up to 180, 173. So we're seeing decent revenue growth. The profit rate is also going up. The operating income also going up. And earnings per share is also pretty good. Membership and other income amount in millions. So we're looking at 1.7 billion just in membership and the other. All right. So let's do something similar to what we did for Google. And we'll say revenue. 3 months ended January 31st. See this their quarters are kind of they're a little they look a little goofy. Anyway, and then there you go. We're seeing total revenue 161,508 for quarter 1, April 30th, 152,301 back in 2023's quarter 1. So let's just see what that growth looks like thus far. So yeah, obviously pretty good growth there. I'd like to go is try to go back all the way to 2021 just to get a bit more trend there. That way we can see like seasonality and stuff. And then this is where I would like to do. Yeah, let's look at their market cap. I'm gonna get that from TIKR Terminal. Let's look at quarterly. What we got 4/30/2023. I want 4/30/2023. Yeah, that's good. Oh yeah, I forgot about that. Yeah, dang it. Um, yeah, but I want it transposed, and then it's not going to give it to me in the order that I want. I know there's a smarter way to do this. Bear with me. Um, it's good enough. It gets the job done, you know. That's all we need. That's all we need. Um, yeah, we'll tell you. Yeah, I'll tell you. I might as well just get all the dates right now. Right, because I did 2021. Last one was 66. Okay. Last one 66. This way we could see what the price to sales is going to look like. Is that right? Sure. Maybe. 66, 64, 66, 63. So we could do price to sales multiple. See if it's relatively cheap relative to historic value. So price divided by the revenue. Okay, 52. We'll just do it as a number. Um, so yeah, revenue. Let me make sure. Amount in millions for revenue. So revenues in millions. Market cap on TIKR is also in millions. Okay, so those values align. Okay, great. So we could then. Oh yeah, but I also want the average. So average price to. Great. So we. Oh, so I can then say this. Okay, great. All right. So here, this tells us that Walmart's trading at a premium when looking at price to free cash flow, because we can see that the current value of 0.52 is more than the historic average value of 0.48. So, like for example, we could look at April 30th, 2024. Let's check out what stock price Walmart was at. Okay, here's something fun. You could see this trade right here. That would have been so this is like using the Fibonacci sequence, right? Fibonacci sequence, and then you uh, uh get rid of this, but you get the EMA 200 line. So now we're doing technical analysis. So we're gonna pivot just for fun. Uh, let's say you wanted to do it there, then you add the VWAP. So now you're seeing confluence within the Fibonacci sequence, right? Because this is your inflection zone, because Fibonacci is attempting to find key support and resistance lines. So if you have a falling stock and it's entering a potential support region, then you can use the EMA VWAP to see whether or not the stock will bounce off those lines. So a little fun technical analysis there. Okay. So historically, April 2024, the stock was trading at a historically higher than average price to free cash flow. But you could see that, hey, that seemed to have not mattered in the long scheme of things. It went up 60% since April, right? So tricky. Looks like there was a head and shoulders pattern there, neckline around there, and it broke free, went down. So yeah, here we saw that higher than usual price to free cash flow ratio value, but it still went up 60%. So even though technically, yeah, this was trading at a premium, stock still ultimately went up. And perhaps you can say rightfully so, right? Because they're not just a store business, right? They're also apparently a global advertising business, right? Just like Amazon, where you go search on Amazon.com for, groceries, or go to Amazon.com to get stuff shipped to you, you're going to get advertisements, right? You're going to get other relevant products, but sponsored products. So vendors and sellers are paying for that ad space. They are paying to be on top of the search. So same thing at Walmart.com. You go to your mobile app, you go to Walmart and you buy groceries there, you're going to get sponsored ads. Maybe you Googled, or excuse me, you searched for Heinz ketchup and Hunt's, or ConAgra, right? They put their brand up there. Um, so perhaps you could say rightfully so. Maybe they deserve to be trading at a premium because they're innovating, unlike Target. I don't think Target has a you know I mean, maybe they do. I don't know. Does Target have a they have an advertising business? They have something called Roundel. I don't know what that is. What is this? Learn more about Roundel, Target's retail media business. Target has long focused on new ways to serve guests, blah, blah, blah. Connect better brands and our guests through curated media experiences designed by Target. So they're kind of like a advertising, um like they recommend how to target an audience, market to people. Target runs and sees what is right online or so it is kind of like, hey, we're going to advertise on Target.com. You can pay for, a slot maybe. Okay. They're also trying to do what Walmart did, connect TV. Interesting. Everything's a everything's just an advertising business at the end of the day. It's all ads. Yeah, so, if a third of Walmart's, because now I'd had to look if like what's Target's sources of revenue, but besides selling products in their retail stores, so yeah, that'd be interesting. But if third of Walmart's revenues coming from that global connect business, that advertising business, then that benefits Walmart greatly because I believe Walmart has a larger consumer audience. Yeah, so grain of salt, right? Premiums up, but that didn't stop the stock from tearing 60%. But I mean, ever since the beginning of 2024, the stock is up. I want the info. Stock is up 84%. The stock doubled. The market cap, the stock doubled. Market cap, stock market doubled, right? So, well, here it's 57%. Yeah, the stock itself nearly doubled. But does that mean Walmart doubled in quality? So the revenue growth was 19%. The market cap was 32%. And from a price to share or sales, Walmart's trading at a premium. Could it be argued that there's a lot of expectation, boiling in this stock price because the stock is already up exponentially? It's kind of it's almost like behaving like a growth stock almost, right? But is there the question now is there heightened expectation, right? Because we're seeing revenue increase 19% since 2024. That's great. Stock goes up. There's a lot of momentum. There's a lot of expectations. But then at the end of the day, Walmart is a retail chain, right? Walmart at the end of the day sells your groceries, and you go to the self checkout line and you get out, right? Um, or is the stock market telling us that it's way more than that? It's a advertising, it's a data, it's a innovative company, right? Yeah, the I would say the downsides is advertising business is one third of the revenue. If there's a recession, that's a terrible R. If there's a recession, then we can see vendor advertising spend goes down to mitigate costs and hail the budget. Um, and so we could see that piece of the business shrink, right? If business partners are concerned about the probability of recession and they want to cut back on costs. Same thing with the consumer, right? If the consumer sentiment is low, then we might see a decrease in spending, right, from Walmart customers. But we did see, we did see Visa come out with great earnings. So they're saying their credit card business, the spend is continuing to increase. So some conflicting results, right? We're seeing consumer sentiment at the low lows. Consumers are not confident in the economy. However, according to Visa, the spend on those credit cards continue to increase. So, what does that mean for Walmart? Do will we see continued spend at Walmart? Um, I thought what was interesting was the most recent quarter from Walmart. We saw how this is the beginning of the month, and then this is the end of the month, and they were seeing how, man, it's hard to write. We were seeing how spend was high at the beginning of the month, and then it would decline at the end of the month. So Walmart was quite literally saying, like, hey, the consumer is getting stretched on their finances. They're getting stretched to the point where they can't buy as much as they could at the beginning of the year when they got or beginning of the month when they got paid. They got to wait till the next payday, right? They got to wait for the next one before they could spend money again. So are we going to see this similar spending behavior occur in the next quarter? Are we going to see consumers stretched even thinner? We might we might see a stretched, even more stretched consumer, and the lower spending that we see towards the end of the month, that's going to lower Walmart's revenue. That's going to lower Walmart's bottom line, and with a exponentially increasing stock price. There's a lot of expectation built up now. There's a lot of expectation for Walmart to hit these numbers because Walmart's not behaving like a retail, retail store, retail chain stock. It's behaving kind of behaving like a growth stock. It's behaving like a tech data company. And we can argue that that's true because one third of their revenue comes from their ad data business. Alrighty. So I hope you enjoyed the live stream today. Was doing research on Google and Walmart, so I figured I would share my initial calculations with you. Um, Ultimately, for Google, I think Google can be worth a position. Uh, but that's my personal financial journey. Your financial journey may be different, and in Trendies is not financial advice. But with the discount that we're seeing on Google and the strong increasing search volume, Google search revenue volume continues to increase. And at the end of the day, Google is not just a search company. They are not just a search engine company. Alphabet owns YouTube, which has more TV hours than Netflix. Uh, they have Google Network, so your Google Sheets, your Google Email. They have a lot of data that they can work with. Um, Subscriptions, platforms, Google Pixel and Google Home and all that, not as popular as say the iPhone, but they still have a market with those Android devices. And then Google Cloud is a up and coming part of their business, up 200% from 2021 to 2025. So yes, Google search is 50% of their business, but there's still a 50% treasure trove where YouTube is the biggest shared platform and Google Cloud is a great piece of AI that they're capturing. And then you can't even ignore Waymo, right? Waymo is like the one big company that actually has cars on the road, unlike Tesla, where Tesla's been talking about doing robotaxi for feels like years now. But who actually has rubber on the road? Google's Waymo, right? So this side of the business is being questioned, but this side of the business is not. And we're seeing tremendous growth in that second half of the business. Even here, we're still seeing great growth in this business. There may be some concerns that Google search dominance is in question, but we're still seeing 50 billion in revenue from those search results. And Google's trading at a great price to free cash flow, price to sales discount. And sometimes you want to buy the stocks when other people don't want it, right? Sometimes you want to buy the stocks that people are fearful of because that discount on the stock price because of uncertainty is what could provide investors a great entry point. But at the end of the day, do I know what's going to happen? Absolutely not. Right? I'm just as blinded, right? But and yeah, we reviewed this, right? Google search is potentially worth twice more than Netflix, twice as more as Oracle, but Google search makes 5 times the revenue as Netflix, 5 times as much as Oracle, right? But investors are so scared, right? And it's like, well, maybe it's not valued right. And then yeah, even from a EBITDA price to earnings, these multiples are also at a discount. So a lot of discount flags happening here for Google. And Sometimes you want to buy the stocks where people are fearful, right? Be bold when people are fearful. Be scared when be scared when others are not, right? Warren Buffett. So, um, but yeah, maybe tomorrow I'll continue the research on Walmart. They have earnings, I believe, on Thursday before market open. So I'd like to see what that's about. A lot of expectation on this stock, so might be interesting to go in with a put. The implied earnings move for Walmart is about 4 to 5%. So just keep that in mind. But I hope you enjoyed the live stream today. Hope you found it useful. If you did, comment in the chat. Comment down below if you found it helpful. And maybe comment what types of topics or stocks you'd like to see on the live streams. Um, if it's cool, then maybe I'll do some analysis on it. Maybe we take requests. So hope you enjoyed, and I will see you all